All right, if you've taken even a quick glance at the markets recently, you've probably seen a whole lot of red. I mean, tech stocks, crypto, it feels like everything is taking a nosedive. So let's get into it and figure out what is actually going on here.
So yeah, the big question on everyone's mind. Why is everything suddenly tanking? It's not just one simple thing. Turns out, it's more like a perfect storm of different forces pitting all at once. First, let's just see how bad the damage really is.
Okay, first up, the big one, Bitcoin. In just the past day, it's dropped a hefty 3.4%. That kind of move really pulls back from its recent highs, and, it sets a pretty nervous tone for the entire crypto space.
And it actually gets worse from there. Ethereum is down even more, tumbling over 5.5%. Now, whenever you see the number 2 crypto falling that much harder than number 1, it's usually a red flag, signaling a much broader weakness across the entire market.
And believe me, this pain is widespread. It's not just isolated to one or two assets. The tech-heavy Nasdaq is down. Major altcoins like BNB, XRP, and Solana are all bleeding out, losing around 5% of their value. So, what's the first clue in this whole mystery?
Well, the most immediate trigger seems to be coming from inside crypto's own plumbing, so to speak. We're talking about a massive, pretty brutal wave of liquidations that basically created a domino effect of forced selling.
It all kicks off with traders who use borrowed money to make these huge bets that the price will go up. We call those leveraged long positions. But when the price suddenly drops, those bets get forcibly closed out or liquidated to cover the losses. And it all began with this number, $87 million just gone in a single hour.
But the bleeding did not stop there, not at all. In the very next hour, that downward pressure just got stronger, wiping out another $130 million in those long positions. You could just feel the cascade gaining momentum.
And here it is, the staggering total. In just 5 straight hours, almost $500 million in bullish bets were completely wiped out. That kind of rapid, forced selling creates a really powerful downward spiral that is incredibly hard to stop.
But, that kind of liquidation storm might just be a symptom, not the only cause. Some analysts, like Jeff Dorman over at Arca, are pointing to a much more complex, almost hidden mechanism that's been putting a cap on any attempt at a price rally.
So how does this option ceiling actually work? Well, try to imagine large institutions selling contracts that give other people the right to buy their Bitcoin at some future price, let's say $90,000. They make money, they earn income, just by selling these contracts. But here's the catch. They only make the most profit if the price stays below that 90K mark. If it rockets past that, their profits start to shrink. So what do? Every time the price starts getting close to that ceiling, they sell some of their actual Bitcoin on the open market to push the price back down and protect their profits.
Okay, so while the option ceiling and all those liquidations explain the how, they don't really explain the why the market is so fragile in the first place. For that, we've got to zoom out and look at a major fear that's spooking all risky assets, from tech stocks to crypto. It's the ghost of a really popular global investment strategy.
This strategy is called the yen carry trade. For years and years, big-time investors have been borrowing money in Japan at almost zero interest, then taking all that cheap cash and pouring it into assets like US stocks or even crypto to chase much higher returns. It's been like a massive source of fuel for global markets.
And you can see exactly why it was so popular. I mean, look at this. From 2016 until just this year, Japan had negative interest rates. You could literally get paid to borrow money there. Meanwhile, the US was offering much higher returns. That huge gap was basically pure profit for these carry traders.
So this brings us to the crucial question. What happens when this whole equation starts to change? Well, the Bank of Japan is now signaling it's going to raise interest rates. If borrowing yen is no longer practically free, what happens to all that money that's been invested all over the world?
This is what the market calls the unwinding effect, and it's what has everybody so nervous. As that profitable gap starts to close, investors have to sell their assets, their tech stocks, their crypto, to get the cash they need to pay back those Japanese loans. And with an estimated $500 billion still caught up in this trade, even a small unwinding could trigger a huge wave of selling across every market.
Now, this global macro fear isn't happening in a vacuum. It's actually being amplified by a psychological battle that's playing out over the single biggest narrative in tech right now, AI. And this has created a huge split in how people are feeling. On one side, you've got influential figures like Michael Burry, the guy from The Big Short, warning everyone that AI is a massive bubble. His new newsletter got over 150,000 subscribers in a month. That shows you how many people are listening to this fear. But then on the other side, you have giants like Disney and the US government pouring billions into AI. This tug of war creates this climate of deep uncertainty, and that makes investors really jittery and much more likely to sell off their riskier assets.
So, as we've laid it all out, there's no single villain in this story. What we have is a powerful storm hitting us from three different directions. You've got the internal crypto mechanics with liquidations and option ceilings, you've got the external macroeconomic fears from the yen carry trade, and then you have this deep psychological battle over the future of AI. But even in this sea of red, there are these fascinating signs of deep, long-term conviction. Big players are actually using this downturn as a buying opportunity. MicroStrategy just bought another 10,000 Bitcoin. Major institutions like the New York State Pension Fund are increasing their exposure. Companies like Visa are building out new infrastructure for the future. This isn't just people passively holding on. This is active accumulation during a downturn, and that's a pretty strong signal that they believe this current panic is just temporary.
And that really leaves us with the ultimate question, doesn't it? The market is caught in this massive tug of war between intense, short-term selling pressure on one side and a foundation of really strong, long-term belief on the other. The next few months are going to show us which force is stronger, the fear that's pushing sellers out or the conviction that's pulling long-term believers in.